I'm Alan Kenny, Managing Editor with REIT.com, and I'm in sunny San Diego for REIT World 2012, NAREIT's annual convention. Joining me is Craig Macnab, Chairman and CEO of National Retail Properties. Craig, your company has acquired about $450 million in triple net lease properties this past year. Where are you sourcing all these acquisitions?
We've had a very good year on the acquisition front. Really two different areas before I answer your question. The first thing is we do it one property at a time. Each one's individually underwritten. The second thing is we're acquiring these properties at very wide spreads right now. Our initial yield's about 8.5%, and then there's growth on top of that. So with the low cost of capital, we're having a very good year. How we do it is kind of interesting. Obviously, the net lease retail market is large and vibrant. We think it's bigger than the mall space combined. And yet, as a pretty small company, we've got a meaningful market share in a very large market. So there are two different ways to do it. One, there's obviously a lot of properties which are marketed by brokers, or sometimes in portfolio transactions, again, generally by brokers. But we decided years ago that if you were buying properties in those scenarios, you were paying the highest price possible. So we started calling directly on retailers. This most recent quarter, all of the about $140 million of properties we acquired were directly from retailers, each one of which is what we call a relationship tenant, somebody we bought a property from in the last 90 to 120 days. So most of us, senior management, acquisition officers, plus myself, are on the road every single week visiting on retailers. And if we continue to do that, disintermediate the brokers, they get a good transaction, and so do we.
And do you think that you can keep up this momentum, help drive the dividend growth going forward?
Obviously, one of the hallmarks of National Retail Properties is a 23-year track record of raising our dividend every year. And if we continue to keep our portfolio well occupied, keep our cost of capital low, and continue to expand our portfolio through acquisitions, I think there's a reasonable chance we can continue to grow our dividend.
And one thing that economists keep talking about going forward is consumer confidence. Obviously, this is a big deal in the retail sector. What's your take on how things look for 2013?
Yeah, so I guess what you're talking about is what a retail sale is going to be like, and consumer confidence is clearly one factor. The two that I watch a little more closely is what's happening broadly with employment, and then secondly with income trends. Obviously the third one is savings as well. But whether we like it or not, we're in an environment where the consumer shops till they drop. And even though employment is not stellar, saving is less than it should be, the consumer seems to find a way to keep spending. I do think that I'm cautiously optimistic next year employment will improve a little bit. There's always population growth, so I think retail is going to be solid next year, not stellar.
Thanks a lot, Craig.
Appreciate what you guys do for us.
And for more on this and other REIT news and analysis from REIT World 2012, check out REIT.com.